Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. Our report, written research report this week, released on April 24th, was somewhat ironically titled Das Kapital. It's obviously a reference to the Biden plans to increase taxes on the corporate sector and increase taxes on capital, i.e. the little presumably trial balloon, although it's part of the Biden plan on his website, tape bomb that hit on Thursday that caused a 65 handle drop in the S&P with regard to doubling the capital gains rate as the top marginal rate. So this will serve as our weekly podcast. It is April 26th on Monday morning. Our YouTube video that'll be on our channel, that'll be edited by our friends at Nucleus 195, and it'll reference that report that we released on April 24th. There's 4 sections to the report this week. The first one is our assessment of the implications of taxing capital and how it can slow investment, but how you should think about it as an investor in terms of what it'll mean eventually, but what it'll mean in the near term from a tactical perspective, whether you should be cutting risk. The next section of the report delves into this broader question about whether we could get a 10% correction in the near term. There were quite a number of strategists at high-profile firms that have been suggesting that we could get a pullback. A number of bond managers who, we always joke, bond managers are always negative because the best they can get is par. But there's a number of bond managers that were negative as well in the financial media last week. We then wrote a little bit about the labor market. The progression in jobless claims has been very interesting. And then some final thoughts on antitrust, the financial sector, and the pandemic. So those will be the 4 categories we go through. Now, beginning with the section we titled Das Kapital and our assessment of what the Biden tax plans mean. We thought that Glenn Hubbard in the Wall Street Journal on Thursday morning, prior to the tape bomb, really nailed it with his op-ed titled "Biden Wants to Spend, Not Invest." The basic message there is that by taxing so much on the private sector and capital, you're really not going to drive investment. You might get more public sector investment, but I don't think most people with any familiarity with classic economic liberalism or market participants that know deep down that government investment is not nearly as efficient as private sector investment would really think that this was a net plus for the aggregate level of investment in this country. More importantly, though, from an investor, because that's always my perspective, it's definitely a negative to have the government be the primary source of investment, not the private sector. It's not exactly going to make your private sector investments like public equities go higher. So this is a lose-lose for investors from our perspective, from what it means in terms of total aggregate investment, but also what it means from a valuation perspective. Our work on historical capital gains rates and equity market valuation implies that a doubling of the capital gains rate, even though it's only on that very supposed high end, would be worth 1 S&P multiple point. The market will price on that, even though, the talking point is, well, this only applies to a few individuals. It applies to a much larger percentage of the capital because those individuals hold a lot of capital. It will, as the Tax Foundation and others have noted, this aggregate plan will put us dead last in terms of corporate tax competitiveness in OECD. And again, that can't possibly make this country an attractive destination for foreign capital. But it is too early to worry about this risk. We would note that the bond market reaction to it was a very serious significant flattening of the 2s, 30s real rate curve. Recall, this has been our proxy for government spending, and we'd seen that curve steepen sharply from January 5th, when the blue wave was ushered in, all the way through the signing of the American Jobs Plan in March. It's been flattening ever since. And the flattening last week to us, we took as an indication that the Biden agenda is losing momentum. We also think that this compares the Biden tactics here compare unfavorably to the Trump tactics. We were critical of the Trump tactics in their first year when they began with repeal and replace and then moved on to the tax cuts. It was as if they were taking something from someone before they gave the public something. This is the same sort of thing. The Biden plans seem intent on leading with the tax hikes. That's no doubt a progressive dream to redistribute wealth, but you're taking things away before you focus on the spending, which is giving something to someone. So we think tactically they've struggled with this, and that's what that 2s, 30s real rate curve is telling us. Again, remember the average Fed duration of purchases is about 6 years. So when that 30-year portion, that yield goes up a lot, it is discounting more government spending and more supply. It's now going down because it's the impulse is moving the other way, because we do think the Biden plan has run out of momentum. We do think they will eventually regain it, and they will spend money. We're just not sure they're going to get all the progressive tax hikes, equalization that they would like. So we do think this will be the source of a 10% plus correction later this year, but it's too early for the market to react to it now. Surely Friday's activity and sharp rally told you just that. So that's it on Das Kapital. Moving on to a section we titled "The Kids Are All Wrong." We went through again how corrections typically take place early in the business cycle. Every business cycle since World War II, the first correction is typically when the Fed starts to normalize policy because they've gained enough confidence that the economy has achieved escape velocity, as Mohammed Al-Arian calls it or describes it. And then you have an 8% pullback subject to a couple of percent standard deviation. They typically last about 6 weeks or so, recover quite quickly. The market will trade in a range and then be on its way for the rest of the bull market associated with an economic expansion. We went through those corrections in the 90s, in the 2000s, and again in the 2010s, where instead of having one of these, we actually had 8 of them, and they were all associated with the extraordinary unconventional policy. They also averaged 14%, not 8%, and that happened after the end of QE1, QE2, QE3, the taper tantrum. I skipped Operation Twist. We had another one when we ended zero rates. We had it when the asset purchases actually ended, moving a little bit in and out of chronicle order here. And then we had 2 during the balance sheet contraction in 2018. So almost, or basically every correction in the 2010s can be traced to tighter monetary and or fiscal policy. So thinking that we're just going to get a 10% correction based on sentiment to us just doesn't fit history. Now, some have gone on to cite complacency in the VIX, and we pushed back on this line of thinking. Just looking at the VIX to us would be akin to just looking at the PE ratio when thinking about equity market valuations. We obviously don't do that. We look at the VIX. We look at the term structure of all. That is the difference between near-term and longer-term options. We look at the premium you pay for out of the money options skew. We look at implied correlation, how stocks trade with each other. Do they all move together? Do they not move together? And we look at the vol of vol. By those measures, our aggregate risk measure is 0.6 of a standard deviation above its long-term mean. So it's not complacent at all. And relative to fixed income or credit spreads, other measures of risk, FX, foreign currency volatility, the equity market measures of risk are even higher. And this would be equivalent to the equity risk premium. That is the earnings yield of the S&P relative to the real 10-year treasury yield. That's elevated as well. So thinking that the equity market is in a position to have a sentiment-based sharp correction just doesn't jive with the price that people are willing to pay for portfolio insurance, not what they say in various surveys. So enough on that. We don't think that that's a potential catalyst for a 10% pullback. A 4 to 6% sentiment-based pullback is always possible, but we don't really think we're set up for one of those. In fact, we think there's probably more risk of a high velocity move on the upside right now than there is one on the downside. So moving on to the labor market, we spoke or wrote a fair bit about how the pandemic-related claims, initial claims, have been plunging. Now, mind you, initial jobless claims all speak to the separation side of the labor market. It's pretty clear that firing is slowed to a trickle. It doesn't mean necessarily that people are coming back to work, but they report continuing claims with a 3-week lag for all these various new pandemic programs. That is trending lower. It's down about 1 million from where we were in March. And we think because these pandemic-related claims have fallen so sharply that those continuing claims are really plunging through the course of April. And we're going to wind up with another very, very strong payroll report in a couple of weeks' time. We'll see. That, again, will be good information, shocking for the Fed, because we do think you're likely to see jobs coming back in those less skilled categories, this so-called K-shaped recovery they're so focused on. It won't be enough to get them to change policy. They clearly want to wait until the third quarter to see the progression of inflation and employment indices or indicators. But still, another big, strong labor report like we had in March brings back that 2004 analog when the Fed got shaken into changing tact in June of 2004. Again, our call is still that they wouldn't start tapering or even talk about it until the SEP meeting. But again, we're always willing to change our mind when the data changes. So final points here this week in our section we called Comings and Goings. We had the antitrust, or we had the, the testimony in committee of Lena Khan, who we've written about, who wrote a very interesting paper about the Amazon paradox and how their vertical integration was, a problem in and of itself. We didn't have to wait for evidence that they were raising prices, that we should move back to this structuralism form of antitrust policy rather than the Bork consumerism or Chicago School price theory approach. And she was, interestingly, very frank in her testimony, typically something that people don't do when they're testifying to be appointed to administrative positions like this. And she seemed to have support on both sides of the aisle. Ted Cruz, for one, said he's looking forward to working with her. So this bipartisan approach to antitrust is definitely worth watching. And it is a problem for big tech. She came out in support of the government's ongoing lawsuits against Facebook and Google. So we would be watching this space very carefully and would not be getting over our skis long in FANG right now. Not underweight them. They're great companies, but keep your eye on this antitrust dynamic. On the financials, there was some commentary that the supplementary leverage ratio issue that we wrote a fair bit about had been much ado about nothing. It wasn't much ado about nothing. There was a fantastic amount of issuance by JP Morgan and Bank of America, Goldman Sachs, Morgan Stanley after their earnings, because they were bumping up against that supplementary leverage ratio, not at the hold co level or holding company level, but at the bank level. And they were also bumping up against the temporary loss absorbing adjusted capital ratio, TLAC. There's obviously an alphabet soup of these regulatory policies that were put in place after the global financial crisis. This is a potential problem for them from a profitability perspective over time. They had to sell a ton of debt. Yes, they sold it at low levels, but they can't put the money into treasuries permanently because the U.S. Treasury funds at a lower level than Bank of America or JP Morgan do. So it would be a drag on profitability. They're going to need loan growth to really get that return on equity back to where it was pre-pandemic, back to 12%. But notably, it is at 10 with all 18 of the constituents of the S&P Bank Index. That's a GIC level 2 sub-index to the financial sector. It's at 10. So 10 is a key level for us. That's good news. The credit recovery is progressing nicely. We belong to stocks, but in the long term, they're going to have to get their they're going to need loan growth to really get profitability to a level where they can truly start performing and not be the cheapest sector on the board. So when all said and done, we don't think a correction is due anytime soon. That brings us back to our highest conviction idea, which is being long the reflation sectors and reflation plays across asset classes. We will be watching that 230s curve. We think the Biden administration will regain some momentum on the spending side, hopefully not on the tax side, because it is such a bad idea in terms of really building the capital stock and regaining competitiveness in this country. But for now, stick with the reflation plays. And it's just too early for one of those 10% pullbacks. The bond managers and kids are all wrong about thinking we're going to get one in the near term. That's it for me this week. This is Barry Knapp from Ironsides Macro. We'd love you to subscribe to this podcast, subscribe to our YouTube channel, read our research on Substack. And if you want to find out more about Ironsides Macro, you can go to ironsidesmacro.substack/about, and you'll find all about how we constructed our research, my background, and what you can expect to get from us in the future. Barry Knapp, Ironsides Macro. Thanks.